Hey, what's up, guys? Agent David O here, and I've got a really special guest for you today. I've got Jeff Kofron with New American Funding. Say hello, Jeff.
Hey, good morning, everyone. How you doing?
Yeah, so Jeff and I, we were out on the golf course this week and just chatting about, the market and what's going on with interest rates. I'm seeing, interest rates keep going up every week as it seems like, and buyers are getting concerned. Like, do they have any options? Is there anything that they can do to kind of combat this? And Jeff's got a really cool product that they just came out. I don't know if they just came out with it, but it's becoming more popular now to kind of combat the rising interest rates. Jeff, you want to tell them a little bit more about the 2-1 buy down?
Sure. So there's a couple different options as it relates to the buy downs. It's not anything new, but there just hasn't been a need since interest rates have been so low, right, for such a long period of time. But since December, we've seen rates go up about 400 basis points, which is 4%. So I think there's a few people, right, that may be sitting on the sidelines. So just wanted to share an old strategy, really, that was really brought about by the building community, but I can jump right into it. I'll kind of share a definition and why it may benefit not only the seller, benefit the listing agent, and then end goal really benefit the buyer of that property. So, I know that win-win is way overused, but it is truly a win-win for everybody involved.
Awesome. Yeah, that's cool. And I've got a document here I can share for folks to see. We'll kind of dive into a little bit of an example here. Is that showing up on your screen?
It is. I can see it
Awesome.
perfect. And I'll just share quickly, the definition. So what we've got here is a temporary buy down lowers the effective interest rate for the first, couple of years in the mortgage. This reduction is a result of the deposit of a lump sum into an escrow account, a portion of which is released each month to reduce the borrower's payments. And then this can actually be used for conventional FHA and even VA loan products. Today, as far as our focus, we're going to focus on the seller paid buy downs. And we'll get over the boring part here in a minute and talk some real numbers and how it can impact the buyer. But we've got a couple different options, what we call a 1-0 buy down, a 1-1-1 buy down, and a 2-1 buy down. And really, at the end of the day, it's super simple how we calculate it. It's really simply the difference between the buy down payment and the principal and interest payment on the actual note rate, or if you want to call it the end term as far as the 30-year term. So we're going to focus on the 30-year term today. And we'll just run through some of these numbers. And what we've got here, and unless you want to jump in and share anything, David, first before I get started.
Sure. Yeah. So, I mean, I've got a listing coming to the market pretty soon here, and it's going to be right at that $200,000 price point. And I thought this would be a good opportunity to kind of showcase this program to the end buyers that we're going to be going after here, to show them that there is a way to get an interest rate in the fives for those first couple of years and really take the pressure off of that big payment that you get with today's rate. And yeah, just go ahead and dive right into this example, and we can show buyers how it's going to be helpful for them.
Okay, sure. So what we've got here is, this is not a rate quote, right? Just to stay compliant. But as far as the interest rate illustration, I'm going to use 7.25 today. Everybody's rate's going to differ, right, depending on credit scores and the complexion of what they're trying to accomplish. But at least under this example or strategy, what we've got is a $200,000 purchase price. And as you can see here on the chart, we're going to use 5% down. So that'll result in a loan amount, obviously, of 190. So let's say the seller may be having challenges, getting some activity, right? Some offers on that property. And rather than even a full $10,000 price reduction, because really in the buyer's eyes, based on current market rates, every $10,000 up or down is really only going to impact their payment about $68 a month. So we're not talking about moving the needle, where this product will help move the needle and at least give them some comfort for the first year, 2 years, 3 years, whatever it is they may choose. So as you can see here, 190 at 7.25. See down there in the lower right-hand corner, it shows principal and interest of 1296.13.
Yep.
Well, if we jump over to the far left column, year one, the buy down of a 2-1 buy down, all that means is year one, the interest rate's 2% lower, which in this case would be 5.25. And then the 1 and the 2-1 buy down means in year two, that interest rate's going to be 6.25. So what you'll see is that 1296 relative to that 1049. What is that? I'm rounding it, but it's about $250 per month, if you want to call it savings. So what you've got there is your principal and interest payment would be $250 a month lower than it would with traditional financing without that buy down. And then year two, you'll see that 1169.86. So what's the difference there? Somewhere in the ballpark of about $125 less per month. So all we're doing under this example is, if you look at the annual savings, that 2963.37 and that 1515.27 respectively, if you add those numbers up, it's about $4,500. So in your example, if it's a $200,000 purchase price on a 5% down conventional, the very max seller credit or seller concession you could even ask for would be 3%. Okay. And obviously the math is easy, right? 3% of 200 would be 6. So you could, if the seller is willing, actually ask for a 3% seller credit, $4,500 of which would go into the escrow account for the buy down, and then the other 15 to go towards any other closing or settlement type fees. So when I talk about $68 a month, $250 or $125 respectively is a lot more attractive than reducing your monthly payment by about $68 per month.
Right. Yeah, that's a good point. And so what Jeff alluded to there was that, hey, the market's changing. No longer are sellers getting 15 offers and 50K over asking price. The rate increases have kind of slowed that down to where there's properties on the market now, and people are having to lower the price and offer incentives to enable to get them sold. And so this option is actually very attractive, to where we could ask for that seller credit, closing cost credit, to cover a buy down that'll buy your interest rate down for these first couple years. And and once the buy down period expires, so when you get into year 3 here, you're fixed at today's rate for the rest of the term. So I think it's a really good option for folks to take advantage of, to take some relief on the payments for the first couple of years. And hey, and you'll be able to keep an eye on the rates. If they drop, you can always refi, right, Jeff? And that money that you got credited from the seller in your escrow account is still available to you. That's correct, right?
Yeah, that's a great point, because one of the concerns may be, well, what if 6 months from now interest rates go down? Well, if they do go down, you definitely want to take advantage, just like we did the last couple of years, right? And that money is the buyer's money. So they don't forfeit or lose that money. That's in an escrow account, really no different than your real estate taxes or your homeowner's insurance. So the one advantage, give a quick plug here for New American Funding, is we service about 95% of the loans that we originate. So what happens is, when that client goes to refinance, what we'll do is one of two things: either one, stroke a check, that's their money, or B, just reduce the principal balance by whatever is remaining in that escrow account, so they can still take full advantage of the buy down that they sought, initially when they bought that property. It's a great point.
Awesome. And when we were golfing, you also mentioned another thing to me about if you and I don't know if this goes hand in hand with the 2-1 buy down or not, but you had mentioned that, hey, if rates go down at New American Funding, they'll actually pay for your refi. They'll pay for the appraisal and the closing costs to actually refi. Is that still the case?
Yeah, a little different than that, just to make
Okay.
sure
Yeah, sure.
we're on the same page. And I can share with you so that you can post it, what we call our 5-year pledge. So what
Nice.
happens is any home that's purchased and the interest rate's locked before December 31st, 2022, we'll actually refinance that in the first 5 years. Of course, I don't know about you, but I'm hoping rates go down in 2023, but
Yeah,
no crystal ball here, right?
sure.
But in the event interest rates go down, we'll actually waive the origination fee and we'll also waive the appraisal fee. So in essence, that'll reduce the fees for that client, at least here within our branch, of about $1,700. Which again, you don't need a big move in the interest rates to make that refinance beneficial for the client.
Yeah, and the key there is you said anytime in the next 5 years. And if you look at historically at interest rates within a 5-year period, anytime across history, there's always been an opportunity to refi. There's always been a steep drop in this graph within the 5 years to where you could take advantage of the lower rates. So I think that's a really attractive a program for folks to take advantage of. If you want to reach out to Jeff, what's the best way to get a hold of you?
Yeah, cell phone's always the best. And again, all my contact information is on that flyer that I know you're going to post. But the
Yep.
best way to reach me is 314-609-1483. Can have a
Awesome.
casual conversation, no obligation, no stress, just no different than the conversation you and I have on the golf course.
Perfect, man. That's awesome. Thanks for jumping on here and explaining this to folks. And I always say this to clients, but the best time to invest is now. Waiting for something to happen in the market or waiting for interest rates to go down like Jeff said, nobody has a crystal ball. So the professional investors are always in the market. And so the beauty of the 30-year mortgage is that your rate's never going to go any higher. And if the rates go down, you can always refinance. And Jeff's got a great program here where you can buy down that interest rate for the first couple of years. And then if you close on a loan here before the end of the year, they're going to be able to refi you within the next 5 years at no cost. So it's an incredible opportunity. I hope you take Jeff up on it. And thanks for watching and tuning in.
All right. Thanks for having me, David.
Yeah, thanks a lot, Jeff. I appreciate it.